markets generally made further progress in the third quarter, and Wall Street reached a new all-time high in July. But returns were much more muted than during the first half of the year, and recent months have been marked by heightened volatility. Equities, bonds and commodities were all buffeted by increasing evidence of a global manufacturing recession and worries that this could spill over into the broader economy, as well as sentiment swings surrounding the all-important US-China trade wars. Thrown into this were mixed messages from the Fed and the ECB as these key central banks eased policy but then cast doubt over further easing moves. Reflecting the sense of uncertainty, the best performing assets in the quarter were safe haven government bonds, with US Treasuries up 2.6%, UK gilts 6.7%, Euro government bonds 3.8%, and gold was up 4.5%. In contrast, emerging markets were under pressure, with equities down over 4%, bonds down 2% and currencies falling over 3%. Developed equity markets made modest gains, led for once by Japan up 3.5% and the US up 1.5%. The MSCI World Index returned 0.5%, held back in dollar terms by falls in the euro and sterling. Key to market moves in recent months has been the indisputable evidence of a broadening global manufacturing recession. Trade wars and disruption in the critical auto industry have damaged the manufacturing and export powerhouses, with China's growth falling to its lowest levels in almost 2 decades and Germany in or very close to recession. Business investment has weakened and the slowdown has spread globally, with growing fears that the consumer and service sectors will be impacted. In combination with remarkably subdued inflation, this pushed bond yields down dramatically. From 2% at the end of June, the yield on 10-year US Treasuries fell below 1.5% by early September, and for the first time ever, the yield on the 30-year Treasury fell below 2%, and the yield curve inverted across the curve, including the closely watched 2-year, 10-year, often seen as a reliable forward indicator of recession. Bond markets around the world followed, with record low yields in Europe and Japan, leading to $17 trillion of debt, close to 30% of the total outstanding, falling into negative territory, and several countries in Europe, including Germany, the Netherlands and Switzerland, having no government bonds with a positive yield. To say this is abnormal is an understatement, and it's increasingly raising questions about the longer-term unintended consequences of central bank policy. Indeed, this issue was explicitly raised by the ECB when, as expected, it resumed an easing policy in September, but also highlighted the negative side effects of monetary policy and stressed the need for fiscal easing to support the economy. In effect, it signalled that we're nearing the limits of monetary policy. The cut in the deposit rate by 10 basis points to -0.5%, the resumption of QE at 20 billion euros a month, and forward guidance to keep rates lower for longer and to maintain the asset purchase programme until just before rates are raised, implying that QE is now open-ended, were all welcomed by investors, but considerable unease was created by the caution around the limitations of monetary policy from here, the sense of abnormality be created, and the negative impact on savers, long-term savings institutions and banks, where the ECB made a concession by tiering the impact of negative rates. As expected, the Fed also eased policy during the quarter, with 2 cuts of 25 basis points each time to interest rates, and several other central banks eased policy or provided dovish forward guidance. Unlike the ECB, the Fed has more room to manoeuvre as it tightened materially during 2018, and the US economy has been relatively strong to such an extent that the Fed was much less dovish than expected in its most recent meeting. It signalled no further cuts either this year or next, providing the dollar with considerable support. On a trade-weighted basis, the dollar was up 3.4% in the third quarter and has risen by over 12% since early 2018. However, recent data is showing US manufacturing suffering now from the global slowdown, and some evidence that this weakness is spilling over into confidence and spending more widely. The market's view that there will be further significant easing from the Fed is unlikely to be disappointed. Progress, or lack of it, in the US-China trade war led to frequent swings of sentiment during the quarter. Trump's policies and unpredictability continue to unnerve investors and are taking a toll on business confidence and investment. However, as the quarter progressed, there appeared to be some thawing of the two sides' tough rhetoric, raising hopes that progress could be made in coming months. Both leaders need a deal to be done. Trump because an election is now in sight, and Xi because the Chinese economic slowdown is accelerating. But both leaders also like to be seen as tough, and concessions won't easily be given. The issue is also not solely about trade. Forced technology transfer, theft of intellectual property, ease of access to the Chinese market, currency manipulation, and cybersecurity, they're all on the agenda of the Americans, and they're not readily solved. There is widespread bipartisan support for tackling these long-standing issues, so this US-China relationship is likely to remain problematic for some time yet, and barriers to trade could well continue as a weapon of policy, thereby extending this long period of uncertainty. Another major area of geopolitical uncertainty is the Middle East, and specifically Iran. The recent drone attacks on Saudi oil production facilities had a sharp but only short-lived impact on the oil price, as production was rapidly resumed into a market that's been oversupplied for several years, due in large part, of course, to the huge increase in production from shale in the US. However, the attack raises the stakes and risks in the region, with Iran widely thought to be its source. Given the rapid relative decline in the importance of oil in the global economy, the risks associated with Middle East instability are much diminished compared with earlier years, but they do remain a threat and an additional source of volatility in markets, especially if there's escalation which results in more permanent damage to oil output from the region. The seemingly interminable Brexit saga took so many twists and turns during the past few months that predicting its outcome is hazardous. With the October 31st deadline approaching, there is some hope, albeit quite low, of a deal being struck between the UK under new Prime Minister Johnson and the EU. Whatever the immediate outcome of the negotiations, a general election in the UK is near certain before the year end, and the result is likely to have longer lasting repercussions for the UK than Brexit. A shift to a far left Labour government with what is now known to be a radical policy agenda, the like of which has never before been implemented in the UK, is widely considered to have deeply damaging and long-lasting consequences. While polls are showing that the Labour Party is trailing well behind levels which would bring them a majority government, the risks and fears of a far-left government and a no-deal Brexit have resulted in a persistently weak currency and sustained underperformance of the UK equity market. Valuations of UK assets are at increasingly attractive levels, and a favourable outcome to these two imminent risk events would result in a sizable rally. Brexit has captivated attention but is not a globally significant nor financially systemic matter. What will drive markets in coming months is the state of the global economy. To date, the weakness we are experiencing has been driven by trade and manufacturing, while the key service sector has remained firm. Employment has been strong and the consumer is generally in good shape. There are no signs of systemic financial problems and an ensuing liquidity crunch, nor of capacity shortages, inflation, and a resulting need for a sudden tightening of policy. With inflation subdued, central banks have considerable flexibility in keeping policy ultra loose for much longer, thereby extending this extraordinary cycle. Slower for longer and rates lower for longer. But caution is warranted in the short term. Equity and bond markets have risen sharply this year, and valuations have become stretched in some areas. Yet the economic backdrop has deteriorated. Risks of a broadening slowdown and recession have increased, and corporate earnings are under pressure, especially in sectors most exposed to manufacturing. A period of consolidation is overdue and likely, but we believe that the cycle has further to run, and there's very strong valuation support from the extraordinarily low yields on cash and bonds, something which we expect to persist for a considerable time ahead. This represents a strong case for staying invested, while also ensuring genuine diversification in portfolios to provide protection from the risks and inevitable periods of shorter-term setbacks.